One of the things that I'm often asked when I hold either open houses or I move around or I talk to some of my friends is that how can I get my first mortgage for my first home in Silicon Valley? It's a problem that a lot of people think that it's really big and insurmountable. One of the people that I thought that would be good to at answering this particular question is Jill James, and I got her on the show today. Hi, Jill.
Hi, Charlie. Thanks. Thank you for inviting me here.
Thanks for joining us. Really appreciate you coming to my podcast. I'm not going to talk a lot. Can you tell us and talk us through how does a person buy their first home or go through the mortgage? And before that, please introduce yourself a little bit.
Sure. Well, my name is Jill James. I'm a licensed loan officer. And as Charlie, as you mentioned, I've been in the business for a couple of decades, more like 3 or 4. And I really like working with first-time homebuyers because I love to help them understand the process and to work it through because it's a very important role that first-time homebuyers play. What we're going to talk about is what is a first-time homebuyer, because that is a different category, and what is a mortgage, another element that people probably know, but we'll just touch on that quickly. How we should prepare for buying a home and getting a mortgage, and what are the next steps, and what is that process?
Will almost anyone qualify to buy a home? I mean, live in Silicon Valley, it's really expensive here.
It is very expensive here. It's also very expensive throughout California. Definitely is an opportunity and a challenge at the same time. So yes, anyone can up to a point. And we'll talk a little bit about what those qualifications are, what may help you get a mortgage versus what may hinder you, so we can work on that. But basically, with starting with a first-time home buyer is anyone who's never owned a home or primary residence before, or someone who hasn't owned a primary residence in the last 3 years. There are some other little nuances to some of these, like income and location, but we can get that. That is more personal, we deal with that. And a mortgage is a loan. It's a source of funds, and you use it to buy real estate. It's also, from the lender point of view, an investment instrument, so technically. And the interesting to June 2024, 24% of home buyers were first-time home buyers. Now that's nationwide. Yeah, it's actually, that was down a little bit. It's usually around 30, but combined with, rising prices, lower inventory, and interest rates, it slowed a little bit, but 24% is very important. And I always tell first-time home buyers being a first-time home buyer is very important because it starts the process. If you don't have a first-time home buyer, you don't have a real estate process going on. People can't move up, people can't move down. Yes.
Is this number also relevant in Silicon Valley, or is this number you think would be higher or lower?
In Silicon Valley, it's probably a little bit lower, but it's not going to be tremendously lower. So there are benefits to owning a home. One, it's an appreciating asset. Unlike a car, you drive a car off the lot and it starts depreciating. You're also building equity, and you can deduct your mortgage and interest and property taxes from your federal income and from a bit from the state. And you have freedom to make the home your own. You're not beholden to a landlord. There are several kinds of mortgages, and basically first-time home buyers have access to all the home mortgages out there. There were a very small amount that will not accommodate a first-time home buyer. But generally, a first-time home buyer has conventional mortgages available to them. You may have heard the words Freddie Mac, Fannie Mae, and even non-qualified mortgages, non-QMs. Those are sort of all lumped into conventional. Now, there are limits to whether it's a conforming loan and whether it's a jumbo loan. In California and in the Silicon Valley area, jumbo starts at $1,209,751. So if your loan is under that amount, you're a conforming loan. So that's the way California is, and the Silicon Valley is particular. There's also government-backed loans, FHA, VA, USDA. VA is Veterans Administration. USDA is U.S. Dairy Association, which is mainly aimed toward rural. Veterans Administration is very popular in California also. And FHA is probably most useful for someone who has some credit score issues, but that's not the only reason you use it. It can also be for lower down payment such. And then the last step is private money. So we can always go that route too. I didn't mention is that at Nexa Mortgage, we have access to 264 more than 265 lenders, actually. So we have all of these covered.
Wow.
Yeah.
What do you mean by 255 lenders? What does that mean?
It's just actual companies that lend money. And each one of those will have more than 2, 3, 4 kinds of loans that they will actually do. And some of them will only be in one part of the market. Some will be in another part of a market in the lending world. So, but the fact that we have all of those lenders gives us the opportunity to find the right loan for everybody.
So if I were to go to Bank of America, that would be one lender, as opposed to you having 255 Bank of America's behind you that can possibly come up with a creative loan for their individual. What would be the difference between, in terms of interest rates, between conventional, government-backed, and private money? Ballpark.
Ballpark is pretty much the same. And government-backed can sometimes be a little bit lower, but they have other things that get involved, such as, mortgage insurance, and VA has an origination fee and that kind of thing. So, but they're in, depending on your particular situation, we'll find the best one. Some veterans just will only do a VA, and it's a great loan. But it's not, you can get a great loan in the conventional world also. And by the way, I've actually gone to lenders and had them create a loan for me once. So it's sometimes it's good to be out there talking to all my lenders. So it's always fun that way.
What does creating a loan mean?
It was getting a lender to change their guidelines to accept a particular scenario for a particular buyer. So I went there.
Wow, you can.
It was
you can change.
Yeah, it's not everyone, but this is a very good. I knew this lender, and I knew they would be open to discussing it. So that's why I had to go do that. And it's actually one that we use for ADUs. Okay, credit, FICO credit, and credit report. There are 9 FICO scores, and we use 3 of them in the mortgage world. So we use the ones that are reported by Experian, TransUnion, and Equifax, based on the Fair Isaac Corporation's scoring methodology. Now, each of those credit bureaus evaluates them differently, so you'll end up with different scores. It's just, and sometimes they're the same, but I've never seen all 3 the same. Credit scores do range from 300 to 850. And you asked a little bit about, can anyone get a loan? If you can get a loan, a mortgage loan, ideally you're somewhere in the mid 7s. Into the mix 600, in the 600s works, down to 600. And we actually do have loan capability below 600 into the mid 500s. Below that, can we do it? Yes, we'll work with you to help you get your credit improved. But basically the credit score indicates the creditworthiness that you show, but the actual score and the credit report shows how you got to that score, what your payment records are. It's very important. It is the first C. And then capacity is the debt to income ratio, where we take income and we take debts and liabilities plus the housing costs of principal, interest, taxes, insurance, and divide it by your monthly income. And your loan officer will help you do that. But we need to get that debt to income ratio between 43%. Some loans only go up to 43%, but some loans go up to 50%. And FHA can even go a little bit higher sometimes if all the other elements fall in place. Next C is capital. What kind of resources do you have to support the purchase and the loan costs? And loan costs include getting an appraisal, getting an inspection. Those are the things you work on. You work on the inspection with your clients, and having enough to actually close. So you can do that with your checking and savings accounts, gifts, and other kinds of accounts, investment and retirement. We do recommend that you have at least 2 months of reserves, which would be equivalent to your monthly costs, that 50% DTI type of thing. It could be 3 would be better. And some loans, depending on the loan, and it's probably not a first-time homebuyer's loan, but it could be 12. You get a better situation if you could do 6 to 12 months reserves. And collateral, that's the property you're buying. The lender wants to know that I'm going to give you some money. How are you going to ensure that I get that money? And this is your agreement that this is the collateral that secures that loan.
With something that has gone in around California right now, with all the stuff that's burning in Southern Cal, is the collateral part of it an even bigger issue, i.e. the inability to buy insurance?
Right. Insurance is actually, I think, more of an issue for people who've had them for a while, and all of a sudden their rates go up and or they get canceled. And that was part of the issue in some of the Southern California folks. Luckily, we have the California Fair Plan is still solvent. And if you have a situation when you're insuring your new home, you can get fire insurance through the California Fair Plan if you cannot get it from a private insurance company. That's one reason I ask people to do it very early in the process, talk to an insurance company and make sure they can get that, especially once they've identified what property they want to buy and where they want their home to be. So it's right now what happens with the folks in LA County is they have their insurance, which is supposed to cover replacement costs, rarely does, because it is a presidential disaster zone. We can couple the insurance payment with a FHA 203K or an FHA 203H loan to rebuild. So that's an opportunity. And you don't have to it's 0% down for those loans.
What's the difference between a pre-approval and a pre-qualification?
Pre-qualification is not underwritten. It does not have an underwriter's eyes on it. Underwriters go through everything with a fine-tooth comb. And because of that, they can sometimes be a thorn in our side, but it's for good reason. So that's why the loan officer will work with the underwriter and make sure that all the T's are crossed and I's are dotted.
This being Silicon Valley and all, will you accept crypto?
Yes, actually, there is a growth in mortgages that are crypto/Bitcoin related. So yes, it is a growing part of it. And yes, we do have lenders that do that. Okay, so now we have a pre-approval. That was step one, and you know what you can afford. You also have to make a decision. A first-time home buyer needs to make a decision, do I want that amount of loan? So they can make that decision. So they can go to their realtor and say, I've been pre-approved for $1 million, and that's what I want to go get a house that's going to be $1 million loan plus whatever I can put down on the property. Or they can say, I've been pre-approved for $1 million, but I don't want to put 800. I don't want to buy 800 and that kind of thing. So, the elements that, again, we're going to look at it in more depth. We did that pre-approval. It was done thoroughly, but we're going to recheck the FICO and what's out in the market right now for your FICO, your credit score, and your credit report, making sure everything is good. Then we do a loan to value, which is determined based on how much is your down payment to the loan amount. So if you have, I'm going to make it very simple, not a Silicon Valley. I know we'll do $1 million, and which is probably still low, but $1 million, we're putting 200 down. So we have an 80% loan to value. That's how that's worked. That does impact your interest rate. And if you go under, or if you go over 80%, like you're putting 15% down and it comes in 85, you may have to get mortgage insurance, which is another additional fee. And then we have debt to income ratio. We're going to go through the loan options with what you can do with your debt to income ratio. If you've been sort of messing around a little bit in the real estate world because you're getting ready to buy your first home, you've probably heard people say PD. Well, what the heck is PD? PD is principal, the principal, which is the amount of the loan, interest, taxes, property taxes, and homeowners insurance. We throw an A in there because a lot of California especially has a lot of associations, so there's an A possibly in your purchase. So, but just so you're aware of the terminology, because your loan officer will probably say, oh, your PD is, and you'll sit there going, so we want to make sure you're aware of that. Principal is just, it's a purely a loan. Now, your monthly payment is also, by the way, creates your monthly housing expense. Principal, interest, taxes, insurance, and association. So now we've gone through the pre-approval. You went to your realtor, you found a home and got a contract. You've inputted updated information for your loan because we have a contract. You do the home inspection and you get your homeowner's insurance. We add more documents because the underwriter may need. Underwriters are good guys. They're just trying to do their job. And they may ask for some information. They may ask for some other data. But we give it to them within a short time frame, and we then get a clear to close. And once you get clear to close, because you need that money, you want to schedule the close of escrow. They finalize the funding for the closing, and then we go to a closing escrow, and everyone cheers and says yay, and you get your keys for your new home. now that we went through the process, but there's something I just want to remind everybody, that what I call the 10 knots of buying a house. Number 10 is do not co-sign a loan for anyone. Don't help them with the car purchase, whatever. Number 10. Then number 9, the next.
Before you go into that, tell us a horror story for, point number 10. I'm sure you have one.
Dad, who was very well situated, luckily, Dad decided to co-sign the loan for the car for his son's Christmas gift. And he was closing the week after Christmas on his refinance. Luckily, like I said, with a little bit of a finesse and conversation with the underwriter and a letter, he was fine. But it's sort of like a little bit of panic at the point. And he bought a car for himself too at the same time. I was like, but luckily he was very well. Don't change bank accounts. Underwriters don't like to see money moving around. They're like, why are you doing that? And number 8 is do not make large bank deposits without checking with your loan officer. So the $50,000 in the shoebox under your bed, do not put it in the bank account. I actually have a client who did that. Okay. Number 7 is don't originate any inquiries onto your credit. Like, don't get that super duper bargain credit card at the store, because it's going to look bad on your credit. Don't buy furniture. Buy the furniture after you close, and do not omit debts and liabilities. I mean, just be an open book. That's how it has to work. Number 4, don't spend money you've set aside for closing costs. That happens frequently. Do not use credit cards excessively or let the current accounts fall behind. And then number 2 is do not buy a car. A truck or van, or you may end up living in it instead of in your new home. And 1, do not change jobs, become self-employed, or quit your job, please.
I have a really big question for you. And the $64 million question here is this. Where do you see interest rates going?
The crystal ball.
You say?
Interest rates they're fluctuating. I call them, they're fluttering. And they go up a little bit, they come down a little bit, they go up a little bit, and they flutter back and forth. It really depends on how the investment world feels about what's going on in our economy. So if they think it's positive, and interest rates can come down a little bit. When I talked about mortgage being an instrument, a lending instrument, there are several of them. There are CDs, which are 3 to 6 months. There is a 1-year bill, T-bill. There's a 2, 5, 10, 30. 30-year mortgages are actually a bond. So if it's risky time, if people aren't feeling good about the economy, they're going to invest in the shorter term. If they're feeling good about the economy, they'll invest in the longer term, and then interest rates can come down. Because right now, 30-year bonds, mortgages are competing to get those investors. So how do you get them? You give them more money. So it's more important, if the investment world is what dictates where we will be. The other thing on a separate point is recessions mean lower interest rates. Recessions are not necessarily great for most people because it means usually unemployed people struggling a little bit. So I don't like to see a recession, but if we do see a recession, we'll see interest rates going down. General forecasting right now is low 6s by the end of the year. Right now we can get wholesale rates in that same number, but in general, because we're a wholesaler, we can get you wholesale rates.
Okay, cool. All right. Anything else any more words of wisdom that you can give us for a first-time home buyer?
I think for a first-time home buyer, it's exciting. It's a long process, and it is a process. So use your team. Use your loan officer, use your realtor to help you through the process. Make sure you have an idea what your budget is, work with your loan officer to help you with those financials, work with your realtor to find the proper home for you and get all those details. It is a process and it is a team process.
Thank you so much for coming on and teaching us more about buying a home and how to get a first-time home buyer's mortgage. Really appreciate you for joining us. Thanks, Joe.
I appreciate it. Thank you very much.
Thank you very much. Guys, if you want to reach out to her and her 255 loan folks behind her, I will put her information in the description below so you can reach out to her email address and a phone number. So thank you again. Don't forget to like and subscribe. Thanks, guys.